The Federal Reserve has just announced its biggest rate hike in nearly 30 years. We know that inflation is rampant. There's so much uncertainty around the economy, and can they land this soft landing? Well, today we're going to unpack this big piece of news. We're going to talk about everything that's flown out of this and discuss some of the key commentary and data points to look forward to as we move into this next chapter of the story.
Sit back and enjoy.
And so let's get into the data. Today we're going to unpack a wide range of different data sources. We'll look at some of the forecasts that the Federal Reserve have provided with this rate rise. And of course, we'll go into some of the commentary before unpacking what this could mean for markets and the economy moving forward. Starting off first up with the current lay of the land. As we know, the backdrop is soaring inflation, of course the potential shadow of recession hanging over not only the US but global economies. We all know about the current state of play, but the Federal Reserve announced a 0.75% rate hike on Wednesday. It's worth noting that just until recent memory, the market was pricing in 50 basis point rises over the next couple of rate decisions, and this 0.75% range only just started getting telegraphed over this past period. However, it's come in now. It was telegraphed well enough that it hasn't taken the market by surprise, and there was actually a bit of a relief rally in terms of the US stock markets on the back of it. It was the largest hike since 1994 in nearly 30 years. As mentioned here, until this week, the Fed was expected to announce a smaller increase. Central bank decided that a larger hike was needed after recent economic news. This is most top of mind was the US CPI inflation print that was last Friday, 8.6%. The hope was potentially for peak inflation to have been seen a couple of months ago when it was 8.5% and would start to come down and see the rate of growth decelerate. We didn't see that, which obviously has driven the need and the acceleration of the decision here. He then claimed that similarly outsized rate rises should be expected at the next meeting unless price rises softened, and we'll look into the commentary later on in this video, so stay tuned on that one. Jerome Powell stated as the Fed chair, "We at the Fed understand the hardship inflation is causing. Inflation cannot go down until it flattens out. That's what they're looking to see." And so building on that there, in the US, which slashed rates to support the economy when the pandemic hit, there was obviously coordinated monetary policy support around the world. The Fed now raised twice. 25 basis points initially, 50 basis points in May, was anticipated to be 50 here, but it's now 75 basis points, and money markets pricing in before this, almost a certainty of 75 basis points again in the month up ahead, slight softening on that. However, even though Powell initially stated they weren't considering the rises, the figures pushed them to do that. And we can see here now that Jerome Powell, just building on his previous statement, acknowledged that this 75 basis point rise was unusually large. We know they traditionally like to rise in 25 bips increments, but inflation surprised to the upside. And so there is the question of, has the Federal Reserve and other central banks moved too late? There was, of course, a lot of discussion. It was almost a consensus view that the Fed had moved too late. Obviously, they were waiting to be data-driven rather than being proactively driven and basing it on future projections like they had in the past. And I would love to know your thoughts on that. Do you think the Fed was initially too late? And do you think they've caught up to the curve yet? There definitely is more of an alignment between market expectations and the Federal Reserve's decision, particularly after this 75 bips rise, and particularly if there's another one up ahead. But I'd love to know your thoughts, so drop in a comment below because it's definitely a contentious discussion. Having a look here at some of the projections, we can see here, and I'd encourage you to have a look at these. The Federal Reserve released this with their decision, but some really interesting ones surrounding GDP, surrounding unemployment as well, PCE inflation, and obviously the core inflation. Definitely worth looking into your own time, but what is worth noting is there's still a broad range of outcomes, and that just has to do with the uncertainty, and of course the need to wait for the situation to continue to evolve. It's not one that is well known. There's a range of different variables, which we'll talk about with the upcoming commentary there. But as we can see here, the aim is for GDP to start to normalize. They're in that 2 to 3% band over in the longer run. Unemployment rate to normalize in and around that 4% range as well. But obviously there's a broad range of outcomes, particularly in these upcoming 2 years. And then PCE inflation too. What's worth noting was that this was a dot plot Federal Reserve meeting. Obviously, the dot plots give an indication of the breadth of expectations across Federal Reserve committee members. And we can see here the median now is in around that mid-threes range, 3.4% for this year in 2022. Obviously, we're in the 1.75% band now for the interest rate. So 3% plus range is going to need a few more rate rises on the way there. We took the first step with this meeting, and then only to go higher again in 2023 is the expectation before moderating, and then in the longer run, getting back to that 2 to 3% band is where they've highlighted around the mid-twos for expectations. Obviously, it's always worthy and interesting to have a look at the insights surrounding the commentary. There was nothing too surprising in this set of commentary with the Federal Reserve decision. As we'd expect, economic activity appears to have picked up after edging down in the first quarter. We know there was a surprise miss to GDP on the downside. And if we have a look at that here, this is essentially what happened. Expectations was because personal consumption was strong, there was going to be growth or a gain in GDP. Private investment was up actually as well. But we saw a couple of key drivers there, two in particular. Inventory balancing coming into it, particularly because of the significant amount of inventory balancing at the back end of 2021. We've seen the difficulties surrounding visibility with inventories continuing with companies like Target top of mind over this past period. But imports as well. Due to supply chain imbalances, the strength of consumption as well, the US was a significant net importer and that drove down GDP. So we obviously had the surprise miss to the downside for GDP in the past quarter. What's noteworthy about that is we're going to get a June quarter GDP read in the next couple of months. And obviously if there's another surprise retracement to the downside, consensus is for a gain here. Well, that will give us our recession, a technical recession with 2 quarters of negative GDP. So that's something that's worth noting. Job gains have been robust in recent months. Unemployment rate has remained low, 40-year record lows on that level. Inflation remains elevated, reflecting the supply and demand imbalances. We can see here a couple of the things they've called out and highlighted. Obviously, the Ukrainian situation, obviously the lockdowns in China as well. They've stated they're still highly attentive, as you'd expect, to the inflation risks. And they've just reaffirmed seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. And this part here is important to read. The Federal Reserve anticipates that ongoing increases in the target range for interest rates will be appropriate. So they're forecasting and telegraphing that well up ahead. Obviously, additionally, quantitative tightening is commencing in this month. They've outlined that with the Federal Reserve's balance sheet discussion in May, but we know that quantitative tightening is happening, and so looking at the liquidity of markets is going to be important moving forward too. And just having a look at the driver here of why this has come through. This is the inflation print that we had last week. Before we unpack what this could mean for the markets, just having a look at this here. So it was 8.6% for all items. As you know here, that's the headline figure. Below the curve there, when you look at core, which strips out food and energy, 6% there. But what's worth noting for Main Street, or the everyday consumer and the general member of society, obviously core inflation is an interesting number to look at. But for most people, a lot of their key costs is going to be on their fuel to get to work, to get to their job, to school, whatever they're doing. For their bills, obviously at home as well. And then food. That's what we're spending a lot of our money on. Most people have got their electronics purchases in 2021 and 2020, potentially spending a little bit on services and things like that, maybe some haircuts, maybe going out traveling. But these key areas are where inflation is being felt most by the consumer. So even if headline is looking at 8% and potentially core is looking at 6%, what's actually being felt to the everyday consumer may actually feel like much more to the hip pocket each and every month as well. And so what's it all mean for markets moving forward? First and foremost, if you haven't yet, we've just launched a second channel live. It's called For Investors. Head on over, subscribe and turn your bell notifications on. Plenty of daily videos across on that channel as well. But ultimately, there are a few interesting data points that will be important to watch for over this upcoming period. Of course, upcoming central bank decisions are going to continue to be critical. 75 basis points is definitely not off the table and in fact would be relatively unsurprising for the July decision as well. But there are a couple of data points between now and then that'll be key to watch. Of course, it's the inflation numbers. CPI inflation every month now is going to be a must-watch topic. But on the other side as well, the GDP growth numbers are going to be important. Are we heading into a recession? How is consumption going to look as well as those individual data points across there? But most importantly, as we come to the end of June, we obviously come to the end of this June quarter. We've seen resets across the board in multiples across many of the sectors, but that's been much more on the price end of the equation. Earnings so far have been relatively resolute. Not perfect. There's obviously been some hits and definitely some cohorts that have been hurt more than others. But if we start to see a hit to earnings across different sectors being driven by rising input costs, which obviously we've seen throughout, and potentially that hit to demand as well as interest rates start to affect personal consumption and sentiment, well, that's going to be important to watch. So I think this earnings season up ahead in July and then August is going to be a key driver about sentiment surrounding the markets and also will help to paint the picture about where things head from here. I'd love to know your thoughts on it all. Drop in a comment below. A big thank you for joining us. It's an interesting time on markets. For now, stay well and happy investing.